let's say there's $1 million reno. You as the landlord are contributing 500K and the tenant is doing 500K. We'll do a depreciation schedule, and lo and behold, it'll say $1 million worth of works. If they've paid for half of it, they'll have an entitlement to claim for it. And if you've paid for half of it, you'll have an entitlement to claim for half of it. But what did your $500,000 go towards?
This podcast is brought to you by Revolve Commercial and the Fast Track Commercial Pro Education platform. This online commercial real estate program is designed to take you from beginner to pro commercial real estate investor, with access to all of my courses, our online community, and monthly group coaching calls, or how to confidently buy your first commercial property today at www.revolvecommercial.com.au. Welcome back to the Revolve Commercial Investor Podcast. We're going to be shaking things up a little bit today, and we're going to be discussing the big T: tax, depreciation, capital gains tax, and issues, and saving as much money as you can on your commercial asset. With me today to help me discuss this very, very important issue is my very good friend, Mike Mortlock from MCG Quality Surveyors. Welcome back, everybody, to today's podcast and YouTube channel. Today, we're going to be talking about long-term wealth through commercial real estate tax strategies, and something that if you haven't thought about it, you should be thinking about it, and that is depreciation. And with me today, I have got the master of depreciation in Australia, the best of the best, creme de la creme, my good friend Mike Mortlock from MCG. Hello, Mike, and welcome to the channel.
Thank you. That's a very kind and generous introduction. I hope I can live up to that to the listeners, but it's good to be chatting with you again.
It's been quite a long time since we last had any conversations, and we probably left it a little bit late considering it's after tax time. But I think this information is, you can never go wrong doing it at any time in the year. And preparation is better than not doing it at all. So, Mike, just for our listeners, for our listeners, just tell us a little bit about yourself and what do you do?
Yeah, sure. Well, I'm the managing director of MCG Quantity Surveyors, and I'm the resident tax nerd. Of course, quantity surveying is a big gambit of different services, but basically, we're the best people to say how much it costs to build something. That's really our background and qualification. And the tax part of it is kind of like a hybrid between an accountant and a quantity surveyor. You still need to be an estimator, but you need to be a registered tax agent and understand the legislation there. Outside of that, I'm on the board of the Property Investment Professionals of Australia, and that all keeps me pretty busy. I love property. I've been doing it for a long time.
And you most certainly are very good at it. And I know you love depreciation, and we're going to be talking about that today, tax saving.
Yeah, and that makes me pretty popular, especially this time of year.
I'm sure it does. I'm very sure it is. So, Mike, a lot of business owners and investors treat property tax like a sort of a once a year payroll job. They just submit their income and their expenses to the accountant and pay whatever tax is left. Why would you say this is the wrong approach?
I would say it's the wrong approach just by what I've seen in my own experience. I would say that the education around depreciation in the residential space is actually higher than in the commercial space, which is unusual because the commercial space is probably more occupied by experienced professionals, finance people. You know, there's lots of work that happens with institutional buyers and REITs and those sorts of things. But once you get to a certain level, a lot of these commercial entities or these businesses that have commercial assets really just put a 2.5% depreciation rate across everything. And I've seen so many cases where the deductions are just left thrown in the bin, not maximized. And, just by sheer experience of what I've seen, it's the wrong approach because your accountant needs to be very, very proactive with it. And there's a million different ways that you can actually maximize those deductions. So if you, let's say you buy a $2 million warehouse, if you're putting 2.5% on it, you're missing all those plant and equipment items that depreciate at much higher rates. And of course, if you're having an improvement or a reno or a fit out, the builder or the consultant that's doing that work for you, they're very unlikely to break that down into individual ATO tax
Mm.
categories. And even if they did, they're not apportioning things like preliminaries and consultants fees, labor and architecture and all of the things that go into building a total installed asset, which includes, of course, the installation. So I've just seen so many instances of people not taking it seriously, and they're the ones paying for it.
So we're going to drill down on all of that. I mean, that is absolute gold, what I'm hearing you talk about, and quite a lot of those things. You're talking about the fees, the builder's costs, and all of that. I think a lot of that gets lost in the whole transition. I've done hundreds of renovations. That's kind of my thing, is uplift properties, and often I find, and let's face it, I'm not the best at filing. That's why I have very, very astute people there to do that for me. But a lot of that, if you're not filing stuff correctly, you're not going to get your tax benefits out of that. Now, just going back to what you were saying, there are two different streams of doing depreciation. And correct me if I'm wrong, there's a Division 43 and Division 40. Do you want to explain to the audience the difference between these? And I think you've just touched on it a little bit there.
Yeah, so Division 40, I would sort of say these are the loose fitting assets that the ATO kind of describe as easily removable without damage. So those, if we think about a residential example, it's carpets, it's blinds, it's oven, cooktop, range hood. If we think commercial, it's things like ventilation systems, security systems, fire detection, emergency warning, dock levelers, automatic entry doors, and it goes quite extreme where the ATO effective lives will talk about things like beekeeping as an asset. There's casino operators, and all of these different types of businesses can have different effective lives. There's about 8 to 10 different effective lives for carpet, depending on the use of a dwelling. So if you look at the ATO effective lives, we're talking around about 180 odd pages. Only really 4 or 5 of those are for residential. The rest of it's commercial. So that's the
Wow.
Division 40 side.
Okay, so if somebody is doing an uplift to their property, or if their tenant is asking for a fit out and they're replacing, let's say, walls, glass, or putting additional glass offices in, resurfacing floors, putting new carpets in, or even every time an aircon system goes down, once they're putting, new air cons that go in, would all of that fall into that division?
Yeah, broadly speaking, it would. With partitioning, it depends whether it's fixed or it's demountable, and that's where you can, I suppose, lawyers make their money in the grey area. Some of those components, like air conditioning, if it's a split unit, that is very clearly Division 40 with, normally around a 10-year effective life. However, if it's a ducted air conditioning unit, that'll actually be partially plant and equipment and partially part of the structure. So that's the other component, the Division 43, and that's the hard component. So if we're thinking about, again, a house, it's gyprock, it's tile, it's concrete, it's retaining walls. If we're talking about a commercial, it could be a concrete floor, it could be the gyprock fit out or the fixed partitioning, it could be an extension itself when you remove the plant and equipment items. So really the hard components, if you tip it upside down and give it a shake, Division 43 is most likely to stay in place.
I love that. Yes, absolutely. You've spoken about the depreciation percentages would be different, if I understand correctly, on the Division 40 and the Division 43 components. Just explain to us why and how, And what is the advantage of doing depreciation schedule every single year on your commercial properties?
Yeah. Well, in terms of Division 43, it's a little bit easier to understand, but it depends on the type of building. So, manufacturing actually has a 4% depreciation rate. There's periods of time where traveler accommodation has a 4% depreciation. But broadly speaking, most commercial property matches residential for Division 43, and it's a 2.5% depreciation rate. So, what that means in real terms, if we think about an established asset, if it was built 10 years ago, what we do is we estimate the total cost to build that property 10 years ago. The plant and equipment depreciates its own way. So the residual amount, the Division 43, the leftover amount, that will depreciate at 2.5% of its value each financial year for 40 years. So Division 43 is the easiest one to understand.
So let's just get clarification between 43 and 40. So Division 43 would be your capital works. So it would be
Yeah,
your
the
building and your
structure.
structure.
Yeah.
So that's going to depreciate over a longer period of time, hence it being a
Yeah.
lower percentage. Is that
Yeah,
right?
and that's really what it sort of comes down to. It's the effective life of the building. Now, there used to be some examples where there were plant and equipment items that had 100-year effective lives, like strong room doors in banks.
Yeah.
But really, the structure at 40 years is the longest effective life of a construction component in a building. So 2.5% over 40 years. Whereas you might actually have something like I mentioned before, a split system. Let's say it has a 10-year effective life. That comes from things like manufacturers' warranties and specifications that say, really, this asset we aren't going to cover in a warranty, or from feedback given to the ATO from certain industries to say these ceiling fans only last for 5 years in the way that we're using them, and those sorts of things. The way that depreciation is calculated on the Division 40 components is slightly more complicated. And this is where people tend to nod off if I'm doing a presentation, but stay with me. Um, the, the formula is really 200 divided by the effective life gives you the rate. So, for example, in residential, carpet now has an 8-year effective life. 200 divided by 8 gives you 25%. So that's the depreciation rate that carpet will have. So
Would that be
25%
the
of
same?
value.
Would that be the same for commercial carpets?
It depends. Commercial has a few different effective lives. And one of the things that I've loved to share over the years is when carpet had different effective lives within the same building. So in pubs, for example, it's had depreciation effective lives of 5 years for drinking areas and 7 years for dining areas. So the
Kidding.
funny thing about that is that someone at the ATO has kind of thought, well,
Oh,
drunk
wow.
people probably spill their beer a little bit more than people that are just there for a meal. So those carpets should be wearing out faster. I mean, I love the idea of those conversations happening at the ATO.
Okay, so I'm thinking more in terms of, I think most of our listeners would be buying, purchasing conventional sort of, units or industrial properties where you've maybe got 25% office, staircase, office, balustrade, aircon, HVAC upstairs, those sort of things. So how would that be beneficial to them in terms of depreciation?
Yeah, well, really, the lower the effective life, the faster the rate of depreciation. So that's the real difference when we're talking about getting a depreciation schedule that breaks the Division 40 away from the Division 43. So taking that 8-year effective life for carpet, which is a residential one,
Mm.
this is where when people are doing a renovation and they're considering carpet versus tile, say, tile is considered part of the structure. It's 2.5% of its value each financial year, whereas carpet's a plant and equipment item. And in residential, 200 divided by 8 gives you a 25% rate of depreciation. So it's actually 10 times better to put carpet into a property than it is tile. And so if we think about, let's just say your typical, maybe it's a strata warehouse commercial property, you might spend, let's say, $1 million on it. Maybe 700,000 is the construction value. maybe 600 of that is structure and 100 of that is plant and equipment items, that 100 versus the 600 might actually sort of be on level pegging in terms of a yearly deduction, because even though the total value of plant and equipment is nowhere near as high as the structure, the depreciation rates are that much higher. So that can actually be side by side in terms of those deductions. And really, the best way to think about it is a dollar today is worth more than a dollar tomorrow. So if it's a $700,000 place to build, you can only really claim 700,000 over the life of the property, but you want to get those deductions as quickly as you can. So maximizing the upfront deductions, given the time value of money, is far more beneficial.
So there are two different streams over here. There's an upfront deduction and there's a long-term deduction. As I understand that from residential. So does the same thing apply in commercial? And what is it called? How does that work? How would it be beneficial in just explain that a little bit in commercial?
Yeah, commercial. I'd probably break it up into maybe three or four categories. So you've got items that have a value of $300 or less. They're immediately deductible. So you can claim 100% of that value in the year that cost was incurred.
What sort of items would those be?
Well, they're typically going to have to be low value items. So it might be a ceiling fan, like if there's a little
Okay.
office area. It could be an exhaust fan or a heat light in a bathroom. It could be bathroom accessories, those sorts of things. So
Okay.
those can be an immediate deduction. We also have seen over the years the government has made some rules around instant asset write-offs, which people will be familiar with. During COVID, we even had things like temporary full expensing. So these mean that we can actually get those deductions up front. Then the other component is low value and low cost pooled assets. And there's sort of two ways that you can enter this pool, but typically that works at 18.75% depreciation in the year of acquisition, and then 37.5% each year thereafter, which is a fairly high depreciation rate. So, an asset that has an 8-year effective life is only going to depreciate at 25%, whereas we're talking 37 and a half. So that's where people might sort of say, like, oh, this is annoying, this is filing, this is a tax return, but it is actually money. The government doesn't force you to maximize your deductions, but people need to advocate for themselves. And there are good and bad accountants, like there are good and bad professionals of every other sort. So I would say you need to have an active engagement with it, ask the right questions, and build a relationship with a quantity surveyor. Even if it is just a one-off project, most people will be happy to answer the questions that you have, and you can very quickly see if they understand their subject matter or not.
Yeah, I would love to do. In fact, I think this is something that I might invite you to do with me, is to take a case study property and run through a depreciation schedule with you so that we can actually show the audience what the difference is of the two different depreciations, the 43 and the 40, and the advantage of really getting as much as possible per annum on your short life products. I think that
Yeah, I
that could make a
think that'd
huge
be good
difference.
fun.
Yeah.
Yeah, I mean, like, fun for me, that's relative. This is what I love to do. I'm a bit of a weird character, but yeah, absolutely. And I would, going back to something that you mentioned before, talking about like fit outs. So
Yes.
there's typical provisions within leases. If you are contributing to a tenant's fit out, that the tenant must then go and get a depreciation schedule. And it's something that I've popped, that's come up a number of times, and it's made me sort of think, gosh, this is a gap that should have been closed a long time ago. Let's say there's $1 million reno. You, as the landlord, are contributing 500K and the tenant is doing 500K.
Mm.
We'll be engaged to do a depreciation schedule, and lo and behold, it'll say $1 million worth of works. If they've paid for half of it, they'll have an entitlement to claim for it. And if you've paid for half of it, you'll have an entitlement to claim for half of it. But what did your $500,000 go towards?
But that would be in tax. You'd have a claim to it in tax.
Yes, yes,
Would you have
yes.
a claim to the full $1 million in depreciation?
You would need to speak to an accountant about that. It's outside of my area of expertise. There are ways that that could be triggered. Again, I don't want to give accounting or financial advice, but normally the tax office says you can only claim what you've outlaid. So, say, for example, if you gave me a rent free period that equated to $500,000, that might be a way to say, well, I've actually kind of agreed there is a consideration that it entitles me to that.
Mm-hmm.
That's where you definitely need to work with an accountant. But in this particular example, if you've spent 500,000 and I've spent 500,000 as the tenant, I'll be engaged to do a depreciation schedule, and then the argument is like, well, who owns what in that particular property? So if this fit out is for an office, if you were smart, you would say, well, I don't own any of the gyprock or any of the tiling because this is Division 43 that depreciates at 2.5%. But I own the lighting and the carpet and the air conditioning and the commercial kitchen assets and the exhaust hoods if it's like a premises like that, because the deductions that you can get on those particular assets are going to be way higher than the structural component. So I wanted to share that as a little bit of a case study where people might understand that there is actually some nuances to this and there's benefits in understanding the difference between Division 40 and Division 43.
So there's two things that I'm thinking about as you're talking about that. So those kind of things, you can get a higher depreciation per year.
Yes.
Um, all right, and that's very dependent on whatever items it is. But as opposed to just 2.5% over a long period, it could be up to what it could be up to. You mentioned 13% earlier and higher, 25% in some cases, and that you could actually claim in 1 year, in your first year of owning that property. Is that right?
Yeah, well, there's some assets. Well, I mean, if the asset has a 1 year effective life, which some unusual ones can, that's an immediate deduction. But yeah, otherwise the pooling rate is generally 37.5%.
Okay. So we were talking about short-term depreciation and claiming maximum depreciation in the first year. And my question is, even if you've got components, let's say that have got a 3-year lifespan, do you get a better depreciation in the front part of in your first year of owning that, or are you going to get, let's say, up to 20 or 25% every single year for the first 3 years that you have that property? How does that work?
Yeah, it depends on the effective life, firstly. So that will dictate what the percentage rate of depreciation is. So you can have assets that actually have a 1 year effective life, or they might qualify as an instant asset write-off. So you're getting all of that in the first year. But broadly speaking, whatever the effective life is, in the diminishing value method, you can do 200 divided by the effective life gives you the rate of depreciation. In the prime cost method, and I know we've just done Division 40 and Division 43, and now we're talking about methods. Oh gosh, I hope I don't get any hate mail for this. But in the prime cost method, it's 100 divided by the effective life. But the way that it works with diminishing versus prime cost is diminishing reduces over time. The clue is sort of in the name. So if you're claiming $1,000 in year one, then in year two, it's asset value minus the $1,000 we've claimed, and then you apply the rate. Whereas with prime cost, it's just a flat 100 divided by the effective life gives you the rate, and you claim that each year as a flat amount until it runs out. So in residential, back when you could claim plant and equipment items, everyone would want to use the diminishing value method because the deductions are higher up front. A lot
Mhm.
of the time in commercial entities, they will use a prime cost method because they're both the same over the 40-year time horizon, but it's a little bit more flat and a little bit more dependable. For residential investors, they love those immediate deductions because we're normally talking about a negatively geared asset, so they can claim those deductions back. And over time, the rents will increase. So it's actually becomes easier and easier to hold a property from a cash flow perspective over time. So those upfront deductions are disproportionately valuable to residential or smaller investors.
The thought that's coming to mind is the decision of how long you're actually going to keep the asset. So if you're buying let's say, a commercial property and your intention to keep that property is only 5 years or shorter, then you really want to get maximum depreciation in the first year that you've purchased that property, so that you're basically putting that money back in your pocket and doing it again. It's
Yeah,
a short-term strategy.
yeah. And now, of course, the 12th of May 2026 changed the rules very, very bizarrely and very sternly. So it's a bit of a different consideration. So if you're buying an established property, really since 2017, you aren't able to claim those plant and equipment deductions. But if you're buying a brand new property, you can decide to use the diminishing value or the prime cost method. It'll be the same deductions over 40 years, but in the first roughly 5 to 7 years, the diminishing value will give you more deductions. That 5 to 7 year mark is around about the crossover. So if you think about a graph, you've got it sort of starting high and it drops down. If you think about prime cost as opposed to diminishing value method, it starts lower, it stays flat. So there will be a point where it overtakes the year on year deductions that the diminishing value method was giving you.
Okay, so it's six of one, half a dozen of the other, depending on whatever the strategy is.
Yes. Yeah. So the length of tenure matters when you're deciding which method to choose.
Okay, so you've touched on CGT. Let's
Yeah.
go down this horrible dark path of what everybody's been screaming about and being very
Yeah.
upset about. How do savvy investors use alternative strategies to keep their wealth compounding, would you say? So, when you're selling a commercial property, there's capital gains tax. And of course, it's triggered when you sell it. How would you say would be the best strategy for that 50% CGT, small business CGT concessions, fit out, scraping, those
Mm.
three topics in when, what your strategy is for commercial properties?
Yeah, I mean, that's probably a whole other podcast in itself, and much of that goes outside of my area of advice and expertise. But my best advice, which is going to sound fairly simplistic, is don't do something and then tell your accountant what you did, because then it's too
Afterwards.
late. You
Yes.
actually want to you won't actually want to model out, okay, well, if I bought it in this entity, or this related entity of mine does the fit out but I own the building, you need to figure out and model how that actually impacts it. I think the best way to avoid capital gains tax is to not make a profit. Not many people are interested in that, and I think sometimes we forget it is a tax on success. It's a tax on profit. People are so negative about it. Of course, if you're having to pay more capital gains tax, there's reason to be negative about it. But there might be things that you can do to offset another capital loss, so you minimize the gain. So it could form a timing decision, but definitely getting the structure right at the beginning, and then understanding if you're making expenditure or you're making a sale, who's doing it and when they're doing it. So that's something that you really need a good accountant to work with, and people that are professionals like yourself in the commercial space can advise on that as well.
And Mike, I think you've touched on something there as well when you're doing a fit out, to perhaps speak to a depreciation specialist like yourself to find out exactly what is viable, what are you putting in there, what does that depreciation look like, how much can you claim back in the first year, and how much can you claim back over a period of time. So I think it's a good mix between having the right people in your corner, basically, your accountant, your depreciation specialist, having the right people asking the right questions, and making sure that everything that you're basically putting in, you're going to be getting out. Um,
Yeah,
but
yeah, absolutely.
I would love to do that exercise with you. Maybe on another podcast, another show, we can have a couple of spreadsheets and numbers, and let's just do a case study. Because I think numbers tell a thousand stories.
If I can get a glass of Shiraz and some commercial tax depreciation PDFs, I mean, that just sounds like an average night in for me, Mish. So I'd love to do that with you.
uh, I love the fact that you're a numbers geek. The Shiraz.
I've been doing this for 20 years. I think it's time to admit it and own it. I mean, I think for people listening, in some respects, I've sort of specialized in this so that you don't have to. For a lot of people, I just make the pain of this go away. And I have a similar relationship with my accountant. Sometimes I'll say, "Oh, why are we doing that?" Or, what's the reason? But once I understand how it's all working, the minutia, I'm like, I pay you so I don't have to get involved in that. So I know, like, and trust them. And I feel like that I'm that to a lot of people as well. But if you're investing in commercial or if you're doing anything in commercial, you need to have a relationship with someone like that.
Absolutely. And I would second that a thousand times over. It is so fantastic to have those, surround yourself with the right team, surround yourself with people who are in the know. And that's the lovely thing about life. We all so different. Um, Let people specialize in what they specialize, make friends, pick their brains, and do reciprocal business. They're there to benefit you at the end of the day.
Yeah, absolutely.
We haven't even touched on the equity and drawing down equity out of your commercial property as you value your commercial properties. But that is a topic for another podcast, perhaps. We won't go there. We'll leave
Yeah,
that one with the spreadsheets. But I think this is absolute gold. Thank you again for joining me.
pleasure.
And is there anything that you would like to leave the audience with as a last takeout?
I think what we saw in 2017 when the rules changed for Division 40 for Resi had a lot more people move towards new builds and commercial. I think this budget change has done a similar thing but turned the dial up to 11. So there's much more opportunity and eyeballs in the new build and the commercial space, and there's also lots of residential buyers that are moving into that commercial space as well. So I would be aware of the experts that you're working with, and the people that have been in the commercial space for a long time aren't there to ride a wave. They're looking for fundamentals, and I think there's some huge opportunities in commercial in the next little while.
Thanks, Mike. I fully agree with you on all of those. We're not going to drill down into them right now, but thank you. I think those are, call them little gold nuggets. To really appreciate your expertise and coming on the show today. And if anybody wants to reach out to Mike, where can they get hold of you?
Yeah, the best place is probably our website, which is mcgqs.com.au. You can email me at Mike at the same address, and you can find us on LinkedIn and Facebook and Instagram. So I'm pretty easy to find.
Great stuff. We're going to put all the notes, all the links in the show notes. So if you are wanting to find out a little bit more, feel free to reach out to Mike at MCG. Mike, thanks again for joining me, and we'll see you on the next one.
Pleasure. Thanks for having me.